Welcome back to Financial Minds Meet the Experts. I'm Jaime Agostino, your host. On this show, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today on Financial Minds Meet the Experts, we are discussing the state of the economy with Fred Eisel, Chief Investment Officer at Vizo Financial, and Tim Sustak, Chief Credit Officer at Vizo Financial. Thank you both for joining me today to talk about the economy. But before we get started, would you mind telling our listeners a little bit about yourself? Fred, do you mind starting?
I'll go ahead and get started. Fred Eisel, Chief Investment Officer, as Jaime said, based here in Greensboro, North Carolina. The word expert, probably a little strong. I don't know if that's maybe the case. Tim and I will talk about what we think is going to happen, but I don't know if we know any more than anyone else does. But been in the credit union industry, probably almost 30 years, 28, 30, almost 30 years now working at the corporate in a variety of aspects, but obviously focused for the most part on the investment and economic side.
All right, Tim, why don't you tell us a little bit about yourself?
Yeah, hi, I'm Tim Sustak, as Jaime said, Chief Credit Officer with Vizo Financial. Like Fred, you can see the gray in my beard here as well. Been around for a little while, probably like Fred, close to 30 years. A lot of that, really all of that with Vizo Financial in various capacities, everything from accounting to the investment department to now with the merger, helping Fred along the credit side. So, as Fred said, certainly we'll have opinions on everything. Everybody can choose to agree or disagree and see if that's, whether we're the experts or not. I guess only time tells who the real experts are after we find out what actually happens. So we shall see. A lot on the table right now, to say the least.
The information we give today will be spot on. Tomorrow it could be completely wrong, but we know a lot today.
All right, well, let's get started. So Fred, I'm going to come right out of the gate. How many times will the Fed raise rates in 2022? And what's your guess for how many basis points you're predicting these increases to be?
That is the big question that the market's talking about and has been talking about right now. I have Bloomberg TV on throughout the day as I watch it. And you talk to five folks, they're going to have five different opinions. You have various members in the FOMC that have their own opinion. Some of the more aggressive opinions are James Bullard, who's a Fed president out of St. Louis. His prediction, and I'm kind of in his camp as well, that the Fed is extremely behind in their fight for inflation. They were using the word transitory quite a bit last year. Tim and I have had long discussions and did not agree with transitory and thought that they were well behind, and that they've admitted finally that they are. And so there was a quick pivot from one or two rate increases in 2022. We were talking around Thanksgiving of last year, that all of a sudden in December, there's a quick pivot that, boy, the Fed's behind and they need to move quickly. I am in the camp with James Bullard, president of St. Louis Fed, like I said, that I think they should. Will they or not? I don't know. I think they should move 50 basis points at this next meeting in March 16th. The Fed's definitely going to move March 16th. The majority believe, and the markets right now believe, the Fed will move 25 basis points at that meeting. I think they should move 50, probably only going to do 25. I also think they're going to move methodically 25 basis points at every meeting this year. So they've got, looking at it right now, they have 7 meetings this year, March through the end of the year, 7 meetings. I think they're going to move 6 to 7 times at 25 basis points apiece. That's what the market's calling for. I agree with that market projection. So as I said, I think they should move 50 in here in March. Some people believe that may shock the market too much. I think the market should be shocked a little bit. I think that also sends the message that the Fed admits that they're behind and they're going to move quicker on tightening monetary policy. So I'd love to see 50. I think what you're going to see is 25 basis points in March and 25 basis points at every meeting throughout this year. So that means about 7 interest rate hikes. So that you're talking about 150 basis points in move to get the overnight rate to about 101.5%. A lot of people believe the overnight rate should be around 2.5%. So there are probably potentially more moves going into 2023, but it's February. It's very early to tell what happens in the world with regard to employment, the economy, interest rates, and of course, tensions in Ukraine and Russia right now. So That's my call, but that may change tomorrow, but today that's my call.
All right. So Tim, do you agree with Fred's forecast for today?
Absolutely not. I think he's a nut. No, no, I actually just kidding. Obviously, actually, I agree with a lot of what Fred said. You know, I have not been in the camp of 50 in March. You know, but I'll say this as well. You know, Fred and I talked about this, like you said, not long back, and he was, you know, in a camp of 50, and I'm still thinking 25. You know, at that point, Fed President Bullard was, you know, one of the only ones really that had come out to kind of ask for that bigger increase and ask for faster increases, and nobody seemed willing to step up and support him. To the contrary, a number of the, you know, various Fed presidents kind of came out and said, hey, you know, we're not so sure. We think a more measured approach is what you want. You know, but since then, there's been a couple come out in support of, you know, being open to 50. So, you know, the market, though, has turned the other way. You know, at that point, the market because was pricing, and certainly pricing in 50, and now they've gone the other way. And, you know, you really can't blame them with the fears out there now around the war that's going on, that they've backed off of that. So I am still in the camp of 25 to start in March. I agree with Fred. Pencil it in. March is going to be an increase, whether it's 25 or 50. They will be increasing rates. They've pretty much told us that. I don't know what could possibly happen between now and then. Well, I shouldn't say that. I better not say that, but I think it'd be highly unlikely to see something that happens between now and then that would stop that. And I also agree with Fred. I think, you know, certainly every meeting this year is live, and, you know, very possible we'll see a 25 basis point increase at every meeting. But I guess my other thought around it too is, you know, I think this Fed has been really good about telling us what they know and what they're going to do. And if you listen to the chair of Powell speak, you know, he's always big on telling us, look, and this is what, similar to what Fred said, this is what we know now, right? But we're data dependent. And with all that's going on now, you know, with all the complications of COVID, now you throw Russia, Ukraine on top of that. At no other time, maybe, do we need to listen to them more and understand that really they are going to be looking at data as it comes in, looking at these things in the world as they evolve, and really using that data to determine what they're going to do. I mean, I think, you know, we'd be liars if we sat here and told you we knew. You know, just like Fred said in the beginning, we're liable to change our thoughts in the next 5 minutes. And I would say the Fed's probably going to do the same thing too, because what they're thinking now is probably what they're not going to be thinking, you know, a month, 3 months, 6 months down the road, depending on how all the things we're seeing in the world evolve right now. So,
all right. Well,
and Jamie, the one component that doesn't make the headlines as much is their massive balance sheet that they've had for quite some time since COVID, the pandemic began March of 2020. So the market, the headlines, Wall Street Journal, the nightly news will talk about Fed increases, rate increases, how aggressive they're going to be. The other component of their monetary easing is this huge balance sheet that they have. So if they move rates slower and methodically, the hope is that they quantitative tighten and really shrink their balance sheet very quickly. That will also be monetary tightening, may not catch the headlines. It's not as sexy as rate increases, but that's two tools that they've used during this pandemic. And so when they tighten, they're going to raise rates, but they also need to be shrinking that balance sheet quite a bit as well. So the thinking is, if they're not as aggressive in moving rates, they may be more aggressive in shrinking the balance sheet as well, which will also tighten policy. So there'll be two things going on here this year. That doesn't get the news as much, and it's hard to, there's really not a whole lot of knowns yet on that. The hope is in March, after this meeting, they'll talk more about their balance sheet strategy and how aggressive they will tighten that. So there'll be two things going on this year with tightening of monetary policy. We'll see how that goes. Kind of going back to what Tim said and I said earlier, I think both, without upsetting the market, will be probably, the rate increases will be slow and methodical. The balance sheet shrinkage will probably also be slow and methodical as they work through 2022. But that's something else we've got to look at. That I said, like I said, won't make the news quite as much. It does in our world and in the Wall Street world, but that the public eye, you're going to see higher rates. You're not going to see the Fed really changing their balance sheet makeup.
Well, will these rate increases and controlling, their balances be enough to control inflation?
I can start and Fred add on. I mean,
I'm going on mute and darkening my camera because I don't know.
Well, I mean, agreed. We really don't know. And I think what makes this difficult, and Fred, see if you agree with this, is, this isn't certainly is not like the standard inflationary scenario where you've kind of had a run up and everybody's doing well. And yeah, we're borrowing because rates are low and buying. I mean, certainly we've had unprecedented fiscal stimulus, to combat the pandemic, but on top of that, now we have all these supply side issues. We'll pull one of the more popular ones out, right? The auto industry. So, I always use the example, one of my favorite places to buy vehicles, they generally have 200 to 300 cars on the lot, new cars. They've got about 10 right now. So, auto prices have been one of the drivers of it, and it is broad based. As the Fed said, inflation is certainly now broad based, but auto prices have been one of the drivers of inflation as it has run up here. And I'm not sure that certainly that's seems to be a supply side issue. I mean, people will say, hey, well, there's demand. Well, there is demand, but when you have a normal 300 car inventory and you skinny it down to 10, even if there's not much demand, there's a lot of demand for those 10 cars, right? And I'm just not sure, those folks that are able to step on a lot and buy at MSRP, or now, we hear about many charging above MSRP. I'm just really not sure that, some 25 basis point increases are going to stop those people and quelch that demand. I mean, throw a couple percent on that. If you're buying a car of $5,000 over MSRP and you have the financial ability to do that, I'm not sure rate increases are going to stop that. The only thing that's going to stop that is, freeing up the supply chain, putting chips in cars and getting them on the lot. So, well, I think certainly, taking some of this easy money out of the economy will certainly allow us to not add more fuel to this fire. I'm not sure that it's a cure-all. I think there's certainly, and well documented, a lot of supply side constraints, not just in the auto industry, but elsewhere that are causing the inflation run up as well. So I think it's difficult to say how much, rate increases will really go to squelch inflation.
That is I agree with Tim. This is the total, going into the dark without any type of light for the Fed as much as you can project and look, and they've got some smart people up there in DC to kind of do this. It is a fine line and a balance of there is inflation. And so controlling that with higher interest rates will help. But to Tim's point, a lot of this inflationary pressure is created by supply chain issue, pandemic issue, ton of easy money and liquidity out there. So the folks that are on the side of the Fed shouldn't move too aggressively, maybe 2 or 3 times this year, because a lot of this inflationary pressure is maybe not transitory, but not maybe permanent. So as demand kind of falls off here this year, and the supply chain can catch up, and we can catch up with chip making, catch up and get 100 cars on a lot instead of 10. It's going to take a while to get to 200 back, but maybe get to 100 cars in a lot. Does that pull down inflation naturally, where the Fed doesn't have to move so aggressively? So it is and the Fed plays this game every time and every cycle of trying to have this soft landing. If they move too aggressively, then they really hurt the purchasing power of us, the consumer. But if they don't move quick enough and inflationary pressures don't ease going forward, then they've got to keep catching up. So it is the big question right now of how transitory truly is this inflationary piece, and do we see that ease naturally at the end of the year? How aggressive the Fed should be? Man, it's just a very tough call. At the end of as Tim said, you raise rates 2 or 3 times. That will and should help inflationary pressures. Some of this is already baked into the market. You see this in the mortgage market. Mortgage rates are no longer under 3%. They're typically based off the 10-year Treasury. And now mortgages are 3.5% to 4% because the market has said, we have inflation. And so the rates on the Treasury curve, rates in the environment have already moved up in in preparation for the Fed moving rates on the short end of the curve. So the rates are already higher. Inflation is high, running very hot. The Fed is definitely behind. I think with the Fed moving methodically this year, that will help a little bit squelch inflation, kind of pull back demand a little bit from us consumers, which allows the supply piece to kind of repair itself through this year and naturally pull inflation. So again, it's going to be a lot of moving parts here, and the Fed's going to have to tiptoe through 2022 to see how aggressive and how much they raise rates, and on the balance sheet side, and really try to balance this out, which is their forever challenge, is trying to balance this out and make this at the end of this year into 2023, where we have, and they don't raise rates too much where they hurt the economy, and now we have a recessionary environment either. So a lot of things in play. As I said earlier, it's February. We can have a completely different discussion here just this summer in June. Who knows what it looks like by the end of this year, given all these factors. So it's a tough balancing act. It's yet to be seen, for sure.
All right. Oh, go ahead.
No, I'm sorry. I was just going to say, and to make it even tougher for the Fed, we know that monetary policy, effects happen with a lag, right? So, you don't jump rates 25 bips and tomorrow it takes effect. So, not only are they balancing everything, that Fred mentioned, but now you have to worry about, how are we measuring how this takes effect, and what we're doing now, compound that with everything else that's out there. It is a heck of a balancing act. One of the toughest ones they're going to have, I think, that we've certainly seen in a while.
Tim makes a great point. Even on the street here, the world we live in day to day, on Wall Street, talking to the economy, listening to Bloomberg TV, it is this belief the Fed moves 25 basis points in March. It's starting to impact the economy. And to Tim's point, it takes 3 to 6 months to really be felt into the economy when financial institutions and others start to adjust their rates. So just the headline news on March 16th, when the Fed does raise rates, the headline news that evening is going to be the Fed raised rates to fight inflation. And it's not going to be immediate. But even in our world, everyone knows it takes 3 to 6 months. But when the Fed moves once, they're just going to think that magically inflation's being fought and things will get better. It's going to take time to get fed into the market. And to Tim's point, if they do 3 to 4 to 5 in 2022, that's going to take into 2023 to be felt. So that's where you can't get too aggressive, because it's going to take a while to really get entwined into the market. And you just want to be careful that you don't tighten too much to pull ourselves in a recession that really isn't necessary. So very tough balancing act for the Fed.
Okay, well, and Fred, you had kind of touched base on this just a little bit, but many economists believe the Fed should have raised rates some time ago, and that their delay has caused more issues. What are your thoughts on that?
It's a good question. I think they're it's not always just one group that creates the challenge. Obviously, we've been through a pandemic. I think we're still kind of in the pandemic, hopefully. Seems like we're getting out of it. We'll see. The Fed, you had this monetary side where the Fed's got to balance this act. The hard part is they've had a huge piece coming from the fiscal side. And we've had 3 stimulus packages since the pandemic began in 2020. So you've got this massive amount of liquidity out in the market. The Fed did what they needed to do. They've learned from various crises in the past that lower interest rates dramatically, ramp up the balance sheet, make money easy to get the consumer and businesses through this pandemic. That was a thought in March, April, May of 2020. And so the government's thrown fiscal money to consumers and stimulus checks and PPP loans to businesses. And the government's trying to do on both sides, fiscal and monetary, to try to just help the consumer and the economy get through the pandemic. So that's where you're at. As we found out through the pandemic, the money really wasn't spent. A lot of consumers were fine. A lot of consumers were hurting, losing their jobs, struggling with daycare, children at home. But a lot of white collar employees, ours included, just ended up continuing to work, just worked from home and on Zoom. So that liquidity stayed in the system and is still in the system. And so you have so is the Fed at fault? Yeah, I think they're partly at fault because they did what they needed to do to lower rates and really ease monetary policy. They have been late to the game to readjust that. But at the same time, they have been saddled with incredible amount of liquidity in the market from the fiscal side that has not been spent, that is not moving anywhere, just kind of sloshing around in the markets. And so they're trying to, they're trying to balance monetary policy with the fiscal side they can't really control. So they're partly at fault. They should have moved quicker. They could have helped a little bit there. At the same time, if you recall, it's been a quick pivot because here in February, we're talking that it seems like we're getting past the pandemic, hopefully. But just a few months ago, Omicron was raging. So the last thing the Fed wanted to do in November, it wasn't that long ago, Thanksgiving. The last thing the Fed wanted to do was, it's not transitory, we have inflation, but the last thing they wanted to do is start raising rates and tightening policy when we were fighting Omicron and people were, again, out of work and trying to battle the pandemic. So they're not in an enviable position. They are at fault. Yes, they could have maybe tightened policy or shrunk the balance sheet quicker. Maybe not interest rates. I think last year they could have eased off on the balance sheet growth last year and tempered that a little bit. That was one of the tools a lot of folks were complaining about. So they're partly at fault. But at the same time, they're challenged with things that there's no great answer to, and they don't want to move too fast, too aggressively to hurt this economy and throw us in a recession while we're trying to get through the pandemic.
Okay, thank you. Tim, any comments to what Fred just mentioned?
No, I think Fred covered it pretty well. I guess I would just say, kind of going back to what we talked about, I think certainly that the Fed is probably a little behind. I mean, they've, so much has admitted it by saying, that inflation is certainly more persistent and broad-based than they originally thought it would be. I think that everybody thought it would be. We thought we'd be beyond some of these supply side constraints that we see persisting. So, are they a little behind? I think certainly possible. How far? I go back to those supply side constraints until we see some of that stuff work through the system a little more. I don't know if we really know how behind they are. So it's another, we'll see. And I'm, that's something they'll evaluate as they're working through, change in monetary policy.
Okay. All right. Food and energy prices, they continue to surge. Why is that? And when will we begin to see that level off or slow down?
Well,
I'm going dark again.
All right, Tim.
Well, I guess the quick answer is with the war that was just started, who the heck knows now when they're going to slow down, because that's certainly going to have a big effect on both. We've interconnected the world's economy, right? So everything flows through everyone, and although we don't get a lot of our oil from Russia. They are a significant oil supplier to the world. So we've seen that reaction in the price of oil jumping. That's since backed off a little bit. But also a big producer of wheat, grains, metals. And Ukraine has been known as the breadbasket to Europe for a reason. There's a lot of agriculture coming out of that country as well. So certainly what we're seeing with Russia and Ukraine is going to affect both food and energy prices. For how long, we don't know. We don't know how long the war will play out. But certainly, I'm sure we've all read at this point about the sanctions that United States and other nations are implementing to try and combat what Russia is doing. And unfortunately, we're all going to feel the pain for that, going back to that interconnected world economy, right? I mean, those sanctions will sting Russia, but likewise, they're going to sting us too. So it almost becomes a test of wills to see who can outlast who on that. I think the other part to that too is, going back to the things we've already talked about, there's supply chain issues in food as well, right? I mean, wintertime, COVID ramps up. You've got people working, side by side in factories and production plants, things like that. And, we get short on workers, and, those supply chain constraints eventually catch up with us. And I think we've certainly seen that as well. Just along with other things, maybe more demand at times for items from the grocery store because we're going to eat out less because, COVID is ramped up during these months and people are less comfortable with going out to eat. So, there's more demand at grocery stores for certain items, and you certainly see that as well. So, I think those are certainly some main drivers, but, when's it going to stop? I'm not touching that with a 10-foot pole. I'll throw that to Fred.
No, I couldn't have said it better. Tim summarized it perfectly. It's very, very difficult, as he mentioned earlier, with the sanctions and our interconnectedness throughout this globe. You heard some reports this morning, even with the sanctions, some of these countries have had some carve-outs just because of the impact of that sanction on that country. So yeah, I'm fine sanctioning, but there needs to be a carve out in Italy, some fine goods, and Brussels, the diamond sector. And it's just like, so they need to carve out because the sanction to Russia impacts everyone else. And to Tim's point, you're going to see the impact in all Western democracies, especially here in the U.S. So we talk about, well, we do a lot of fracking. We produce a lot of energy on our own. Russia does supply a lot of energy throughout Europe. Impacts them quite a bit. So they're kind of tipping their toes on how aggressive they want to be on their sanctions as well. The big talk was getting them off SWIFT, but it sounds easy, but not as easy, and it really impacts everyone globally. So it's just a very, very difficult situation. So to Tim's point, and said it very well, we're going to see the impact here in the U.S. no matter what type of sanctions we put in place, and even if we go down more tranches and get more aggressive there, it's just going to be very difficult. Rumor talk this morning was Putin was going to get a delegation together to meet and talk about some things this morning. That's why the stock market's up a little bit today. So hopefully this is a quick process and there's quick resolution to this, because the longer this goes on, I don't think we have any interest and do not want to put troops on the ground. If we have more and more sanctions, there's going to be more and more pain for Russia to an extent. There's going to be a lot of more and more pain for the U.S. consumer as well, unfortunately. So take this out of the equation, as we've been discussing, the pandemic coming out of that, lower rates, liquidity. There's enough going on that the Fed is, and the U.S. government, the government, President Biden, the Fed, and Jerome Powell. It's a lot to struggle with and trying to figure out where to go. You add this in the mix, it just really muddies the waters even more. So it's a very difficult situation right now.
All right. Well, since we're kind of already talking about the Russia-Ukraine, I'm just kind of going to jump to that topic specifically. I mean, how will this impending war, what are some of the factors that will impact, the U.S. economy, and how can credit unions prepare for the impact that might cause?
That's a tough question. Especially the impact of credit unions is tough. It's going to be very deep in the weeds on getting to the credit union side of things. Obviously, this is a major global geopolitical issue. How that really hits home for a credit union in South Carolina is going to be tough. It's going to be more, not so much the credit union, maybe more the consumer, with higher gas prices, higher prices at the grocery store, and their ability to spend money and their interest to spend money. So that may start to drive down some of their liquidity they've had at the credit union for some time. That liquidity that's been around since the pandemic in March of 2020, it's been there for 2 years. People are thinking it's going to be around here for a while. Well, the cost of things increase, the consumer is going to spend more out of their pocket to day-to-day live. Wages are increasing somewhat, but is it fast enough versus the pace of inflation? That's going to be the thing to see. And then will there be an interest and desire to borrow money? If it's costing me more to buy groceries, to pay for different things, my wages are increasing, but I kind of want to see where things play out. Maybe my demand to borrow money for that new car, maybe I'll wait a little bit to see how that plays out. So it's hard to see how this all plays out and what the impact is overall. We're seeing it now, as Tim mentioned, with kind of wheat prices, commodity prices, and especially fuel. As this goes on longer, it's very difficult to determine how this will impact the global economy and the U.S. economy, specifically driving down to the credit union, the consumer. I think it's just going to come back down to you have inflation already coming into this crisis. This only impacts and inflates and creates more inflation because of the supply demand and issues we have here. So I think it boils down to the consumer is seeing inflation and how do they deal with that in 2022? And even if the Fed's moving rates higher to help quelch that inflationary pressure, if this conflict continues, I'm not sure there's a whole lot the Fed can do to control that. There's not a whole lot they can do at the price at the pump. If a lot of folks will pump gas and complain the Fed and the government aren't doing enough, well, it's just a supply demand issue. And when you've got major supplies being shut off over in Russia, that's just going to impact fuel prices globally. That not a whole lot of things we can do here. So how it impacts the credit unions, I think it's how it impacts the consumer. And it's not just Ukraine-Russia issue. I think it's inflationary issue and some other stagflation situation where if prices keep going up, I'm just not going to buy because I don't know how far prices are going to go and can a Fed really control it and how aggressive they're going to be. That's probably what to look for. So, and I think for some credits, I think they're okay if they lose some liquidity. I was on a call yesterday with a member. It's got so much liquidity. They're almost starting to talk to some of their higher deposit members and saying, hey, we can't hold it anymore. It's impacting our capital ratios. We can't really pay anything. So some of these folks would love some of this liquidity, honestly, to kind of move out of the system a little bit. So it very well may move out just because of the cost of things are greater and the consumer is not looking, is going to spend down more of their money. There's no more fiscal stimulus packages coming. So a lot of that money will start to get spent down. And so the creditors are just going to be looking at interest rate increases if that's coming just for our domestic economy. And then what's the consumer going to do the rest of this year with higher prices? And if this conflict continues, what's that mean for their purchasing power? What do they do with their their cash funds sitting at the credit union?
Okay, thank you. Are you guys still okay with time? I've got a few more questions I'd love to throw at you if you're still good on time.
Absolutely.
All right, great.
Yeah. We'll keep giving you some general no answers to your questions. Yes.
All right, well,
keep them coming.
All right, let's change to the labor market. So I was at a recent credit union event and a few credit unions were kind of mentioning how hard it is to find employees. Will this be the new norm for credit unions after what we're calling the Great Resignation that we've recently experienced over the past few months? And how will that then impact the economy and the credit union?
I'll start. I guess I think it certainly is the new norm for right now. Anyway, and I'm interested to hear Fred's comment here because I know he's really well read in this subject. But I mean, it's no secret that as the baby boomers start to retire, we're going to have more of a gap. Certainly with the workforce. And I think, certainly with the pandemic and everything that has gone on there, that's probably accelerated some of what, we were going to see there over time, probably push some people. I mean, I'm sure we all know a number of folks that, have retired over the past, year or so that before the pandemic, maybe would have held on a little bit longer. So I think certainly that's in play. As well as just, with the upheaval of the pandemic and, people kind of reevaluating what they want to do with their life, where they want to work, how they want to work. It's pushed a lot of people to, as you said, Jamie, we hear about the Great Resignation, a lot of people deciding, you know what? I don't want to go back to the office. I'm going to work from home. I'm going to do my own thing. I'm going to be a gig worker. I'm going to start a blog or, whatever else. And for the short term, I certainly think that sticks. And I think it sticks to a certain degree. But I think kind of with everything else that has a nice, shiny look to it at the start, over time, I think folks, some of those folks anyway, start to realize that it's really difficult to be your own boss, and it's hard to pay for the health insurance and other things. And, entrepreneurs have known that for a long time, talk to the folks that are out there grinding, through some of these industries. Fred and I have been talking about, some of these industries that have been hit by the pandemic, the dry cleaners, the mom and pop shop that, has, the family has had a pizza shop for 50 years, right? I mean, the hours they work, what they work for, which is a lot of pride in having a family business. It's a difficult life. Your life is not your own. That business is your life. And, a lot of the kids don't want to take that on. And I think over time, people will start to realize, not quite as easy as I thought. Maybe it wasn't so bad working for a company that took care of a lot of these different things for me. So, I think in the short term, definitely. I mean, the employee kind of has the hammer now, which they haven't had for a while, to be able to go out and move around a little bit, look for different jobs and improve their situation. But all things ebb and flow. And I think eventually we'll see that calm down a little bit and go back to a little bit more of what we would consider normal. So,
all right, Fred, what do you think?
I agree with Tim. And as he said, we talk about it quite a bit on our own, and I agree with him completely. And part of it's the economy's changing a little bit, maybe a lot, depends on who you ask. One example is we had a board meeting in Richmond, Virginia last year, and talking to the hotel hostess there. And obviously I was waiting for a coworker and just talking to the person who was kind of hosting in the lobby there, and said, "Are you guys full?" She said, "Yeah, we're full." Well, full meaning we got 50 of the 85 rooms full. We say we're booked because we don't have enough housekeepers to clean the other 35 rooms. So we are as full as we can. To the right is the restaurant. It was dark because we don't have any servers. We can't find a server. Finding a server in downtown Richmond is like a unicorn, because a number of things have happened here. Like most communities, Amazon built a warehouse facility right outside of town. So, and that's happened in a lot of communities. So the server that's making, and she said, and I can't remember the numbers, I think it was like $7 an hour plus tips. Well, during the pandemic, obviously no one's coming in, so you're not making any money. What's happened since then is just a different society, where and this is right outside the state house of Virginia, Richmond. So you would think there's a lot of business, white collar, lobbyists, politicians there, probably on an expense account. And that's what she was saying, that you have a server who's making $7 an hour and the tips are terrible. Like no one tips anymore. So the person's making $9 an hour. And dealing with attitude, and you see that now on airplanes and different things. So the people are like, you know what? I can go down and move boxes around at Amazon for $20 an hour. May not be my dream job, but nor is waiting tables here at a restaurant and taking crap from the patrons for $9 an hour. So what they've done at the restaurant is guarantee $14 an hour. If you don't make wages and tips up to 10, we'll supplement with another 4. They're trying anything they can to bring people into the workforce. Still can't find anybody. Same thing with housekeepers. The hotel down around the corner was paying $20 an hour. They were paying 13, so they had to keep stepping up wages to try to attract workers. So that wage pressure is staying. So the question is, does that stay once we get past this pandemic? Well, I don't think a lot of folks are going to pay $20 an hour. I don't think a lot of companies are able to then just say, hey, well, next year you're going back to $12 an hour. You're going to run into the same problem you have currently. Going back to Tim's comment, just demographically, you have a ton of people leaving the workforce naturally, retirees every single day. We are, as a country, aren't creating enough children. The birth rates are much lower. We're not backfilling our own population, and immigration is kind of tighter. So we just don't, and this is not a problem since the pandemic. I always point to, we had a interest rate strategist speak at our financial conference. I think it was like in 2018, 17 years ago, that we had this problem years ago. The birth rates in this country were lower than the jobs we were losing to retirement, the baby boom generation. So while the millennial generation is huge, we don't have enough people in this country. And you add to that Amazon, where you may have got a box delivered to your house once every couple of weeks. Well, now you may have a box delivered once a day or multiple times a day. So in order for Amazon to fulfill orders that we expect today, it used to be 1 or 2 warehouses. Well, now they're building warehouses everywhere to kind of keep that delivery chain going. So they just need workers constantly. My son my 22-year-old while he's finishing up school, works at FedEx here in Greensboro. And I said, are they still hiring? He said, just the other day, they had 10 people come through for their intro orientation piece. And he just got hired a few months ago. They just keep coming, because there's 40, 50,000 packages a day coming through the facility, his one facility. It's just so the economy's changing to where shipping and the delivery expectation is immediate. Why am I going to wait a week for the package? I want to get it today or tomorrow. The only way to do that is to build a facility nearby every city. So the Richmonds of the world, the Greensboros of the world, are now competing with the logistical system of you need more truck drivers and package handlers. Well, I'll do that for 20, 25 bucks an hour than work at a restaurant for $7 plus tips. So those jobs are going to be hard to fill going forward. You see nurses kind of getting out of the industry because just COVID has just wiped them. My 28-year-old daughter's a teacher, looking to kind of go to the private sector and be a trainer there, just tired of the educational system and what's going on there. It's kind of been a rethink of, since the pandemic's kind of ripped the Band-Aid off of a lot of companies, a lot of industries, a lot of folks rethinking, what do I want to do with my life? To Tim's point, maybe I just do my own thing. And maybe if I'm not comfortable with that, I'll work for a company, but I'm not doing this anymore. I want to do this. And oh, by the way, I want to work from home. I could have worked from home years ago. Pandemic proved I can work from home very effectively and efficiently. So I know a couple of people that have gotten jobs that are job in Colorado, companies in Colorado. I got to go out there once a month, but I work here in Greensboro, but the company's based in Colorado. They want that flexibility from working from home, take care of kids, and they learned that having that flexibility is key during this pandemic. So the demographics are changing, the economy's changing. What we want to see and do now is kind of diverting workers to other parts of the economy. So it's going to be a challenge for a while. I don't see how the credit unions, it's not going to get any better. You're going to still have to kind of get tellers at the teller window, and you're not going to get them for 12 bucks an hour anymore. I don't care where you're at. You're going to be competing. Well, it's a teller. I'm competing with the Bank of America or PNC. You might be competing with Amazon. He or she may move boxes for 25 bucks an hour because, the difference between $13 an hour and $18 an hour is significant for folks at that wage level. If you have kids and your rent's going up everywhere, rents are going up, gas is going up, food's going up. I'll take $2 or $3 more an hour. That makes a huge difference. So I will do something completely different if that helps supplement my income. So just a lot of moving parts because of the pandemic and how the economy's changing. And in the fight, this great resignation you mentioned has really got people to rethink, what am I doing? Where am I doing it? And how much am I making?
Sorry, that's a lot to digest there, Fred. I am speechless.
You're speechless.
I'm taking it all in. Well, I mean, because you were talking about, just shipping and things. My brother-in-law owns a trucking company, and he can't find truckers for the life of him. I mean, he's I'll pay for your license. Who's interested, kind of thing. And just listening to you talk, and then as the credit unions are saying they're having trouble filling those teller lines, because of the salary. I mean, that's where it comes into play.
And that goes for the carpenter, the electrician, the HVAC guy. We had our refrigerator repaired yesterday. Nobody's getting into the refrigerator repair business. Those folks are the 65-some-year-old older guy.
Yeah,
they're leaving. The 20-some-year-old's not getting into the appliance repair business. So to Tim's point, the pizza shop, the Chinese restaurant, mom and pop came from overseas to open a Chinese restaurant as their freedom card. The kids have worked there, but once they get their college degree, they're not running a Chinese restaurant. So a lot of these industries, it's hard to backfill with the younger generation because that's not exactly really what they want to do.
Yeah. And there's a lot of other push and pull in that too. And did you say it was your brother-in-law, Jamie, that owned the truck? I mean, I'd be interested to hear what he thinks. I mean, when you hear of the technology coming, self-driving technology, the fact that, hey, you know what, over-the-road truckers won't need them anymore. The truck will drive itself, and you will just have folks, shuttling trailers back and forth between destination points. A young person hears that, is a truck driving career something you want to get into? So, there's so many things that are pushing and pulling unemployment right now. I don't know. Is that something that he finds? Are people more reluctant to get into that industry because they think the longevity might not be there?
Yeah, I mean, it definitely could be a factor, but I mean, he's running also up against, there's such a high demand for truck drivers right now that he's competing with other trucking companies. So, it's more than just, there's the benefits package, like there's so many factors that are coming into play, and he's trying to compete with everything out there and staying informed of what all the other competitors are kind of offering. But to, Fred's point, it's not just the trucking company that he's got to be looking at their benefits package and salaries. He's got to be looking at these other companies too, because they're taking, the workforce as well.
Yep.
So
Yeah.
it's really interesting to kind of think through that. And to your point with restaurants, I mean, just the pandemic alone, I mean, how many restaurants did you guys see close in your area due to the pandemic? But then, the workforce is also causing the issues. I mean, I wanted to order something the other night from a restaurant and they were closed because they didn't have anyone to work. So they had to close that day because they had no one working.
Yeah, you see restaurants that we have a couple one of our favorite restaurants is now open 4 to 10. They don't do lunch anymore. They're closed Monday and Tuesday, I think. Just don't have the workforce. And so when those folks have to pay a higher wage, that the restaurant industry specifically is a very tight margin business. And so when you can't find workers, or if that worker, I can move a box at Amazon for 18, or can I make more money in tips here? Yeah. Okay, I got that worker, but he or she's costing me more. That just crimps that tight margin already, and their cost of goods for food and a cup or straws or napkins increase. And so that's what, as a consumer, we're going to see now. Going back to where we talked about, the Fed raises rates and controls inflation, but that McDonald's Happy Meal is probably just going to stay more expensive than it did 2 years ago, just because that employee, if the Fed raises rates, the employee's not taking a pay cut. The benefits aren't going to get any cheaper. Healthcare is not going to get any cheaper. So that wage inflation kind of ramps up all other costs. Costs of their goods increase, and so pricing just going to have to naturally increase in a very tight margin business, and that's for a lot of companies. So even with the Fed aggressively move rates, I don't know if that does a whole lot. What you see in the housing market, that's for our next podcast, but the housing market you see in a lot of these cities, rents are going through the roof, and rents aren't going to go back down because there's just a lack of supply of housing in this country, thanks to the financial crisis many years ago. So we just don't have enough. And when we have lack of supply, which we have now, you have a massive demand for home buying and a massive demand for rents and rental properties in your typical apartment complex. And those rents in Charlotte that I know are close to $2,000 a month for a 1-bedroom apartment. Those aren't going lower. And that puts a lot of pressure on the pocketbook of folks that are working day to day.
Yeah. Well, let's take a couple minutes and kind of, help some credit unions out. I mean, investment rates for the past several years have been, a little low. So hopefully that's about to change. Any advice for credit unions regarding investing in this rising rate environment?
Kind of sit tight and be patient. As I said earlier, the liquidity profile we've had for the last couple of years is we've had a ton, and it's not going anywhere. My concern is throughout this year, you may start to see it leak out as, again, is no more fiscal stimulus packages. The consumer will spend their money. And hopefully, again, fingers crossed that if we are past this pandemic and things kind of open up more, the consumer will continue to spend down what they've had at the credit union for such a long time. And the cost of goods are going to go out higher, of rent, of gas, and other things. It's just going to take more of their paycheck to survive. So part of my thinking is just keep an eye on liquidity. You'll say, Fred, I got so much, it's ridiculous. I know you do today, but it's early, and we got, as we talked about onset of this call, there's a lot going on. So just going to be careful with that. You've got a Fed that's extremely aggressive. We think it's going to be extremely aggressive this year, raising rates. They may not do 50 in March, but if they do 4 to 6 this year, your overnight rates 10 or 15 basis points right now, it very well could be 1.5% by the end of this year. It's a very big move. So when you're looking at your ALM model and say, well, when are rates going to go up 200 basis points? The 2-year Treasury was at 70 basis points in November. It's right now at 160. So it's gone up, almost 100 basis points in 2 months. So it may not be instantaneous 100, 200, 300 basis point shock overnight, but if you're starting to put on investments today at 1 or 1.25%, that could be a very different rate in 3 to 6 months from now. So I would preach patience. I would stay short meaning inside 3 years on the investment curve. Just because, and what we're seeing with our credit unions, a lot of folks are just staying in cash. Yes, they could buy something now at a rate and kind of make something better than cash but that cash rate's going to be moving very quickly, assuming the Fed does what we think it's going to do. So you just kind of want to be patient, watch liquidity, stay short on the investment side 3 years and in. We have a lot of members buying 6, 12-month CDs, Vizo CDs or Simplicities. That's a good trade. Buy something into 1 year, let it come down the curve. Rates probably will be higher, reinvest. Maybe loan demand picks up finally. You can ideally put it back in your loan growth. But patience, keep an eye on liquidity long term, and stay fairly short inside 3 years. Like I said, most members are looking 12 months and in. I think that's a good trade at this point, given the uncertainty of the Fed. It might be the velocity of the Fed. It could be a very different rate environment 6 to 9 months from now. You don't want to be kind of putting everything in the market now, when it could be a completely different market very soon.
Okay. Are there any other key factors economic factors that credit unions should be looking at right now?
I guess I would just say, and kind of along with what Fred said, investment wise. I mean, I think liquidity is always my fear for credit unions in a time like this, because margins are pinched. There's a lot of liquidity there. Obviously, there's pressure to make some income, but it's a bad time to get greedy, and it's a bad time to place big bets, right? Because it's generally easy to recover from income issues than it is when you have a liquidity issue. A liquidity issue is very acute and can sting very bad very quickly. So I think the worst thing you can do is to Fred's point, extend out, get greedy at this point. To go along with that, it's a great time to be using your ALM model. Right. I mean, I think a lot of times we look at that and we run the reports and we throw them in a folder so we can show them to the examiner. What better time with the volatility that's going on and all the things that are pressing on the economy right now and pushing things around? What better time to run some scenarios in the ALM model with where you think rates are going, where you think your deposits are going, and find out, how does it affect my income? How do I fund things? I think, we have tools to use, and now is a great time to dust that off and start running some scenarios to find out how your balance sheet reacts. I would say that, and use car prices. Keep an eye to that, because it's no secret that used car prices have shot through the roof. I was just looking at the Manheim Auto Index today. February to February last year is up almost 40%. So as we're making loans on autos, we could have a fairly, depending on how quickly things change in the auto industry, we get new cars on lots, we could see a fairly rapid and significant turnaround in used auto prices. And obviously that hurts recoveries when you have to go and repossess and sell a car. So I would say just keep an eye to the auto industry, because that's something that can move pretty quickly given the type of run up in prices that we've seen.
Yeah, I completely agree with Tim. I think just to remember, for folks to remember, this is all manufactured at this point. We got coming into the pandemic, the economy was good in a good spot. The Fed was raising rates. It kind of came off that a little bit, but things were good. We're still in a pandemic economy where the Fed has been extremely aggressive and easy money. On the fiscal side, we've gotten a lot of stimulus money from the government in the last couple of years. So we're in a created economy right now of what we've got: ton of liquidity, low rates. The supply chain issue, of course, hugely impacted by the global pandemic issue. That will continue to get better as we get past this. So to Tim's point, this could change quickly. Car prices, home prices, liquidity profile, rates could get back to normal. If you have a rate environment of an overnight rate of 2.5%, that's still low, historically speaking. Now, the recency bias is, well, we're at zero. How do we get to 2.5% rates? Well, it's because we're in a pandemic. If you think back just a few years ago, we were getting close to that point. So we're in this pandemic environment. That's our thinking right now, is kind of get that pandemic hat thinking off and say, okay, if the Fed moves, it could move into 2023 and we can have an overnight rate of 2%. While, as we've talked this podcast, it's going to be kind of painful for the consumer. For the credit unions, it's actually a good time. they've had very tight to no spreads for the last couple of years, and a ton of liquidity and really nowhere to go with it, with low loan demand and horrible investment rates, as you mentioned. So as the Fed starts raising rates on the short end, they're going to make more just sitting in cash. That will improve. With the way the cranes work and the number of cranes I've talked to, no surprise, they're going to keep their share rates pretty sticky. So as the Fed raises rates and they make more in cash, spread will just generally improve. Mortgages, if they're putting mortgages on the books or car loans on the books, it's not going to be sub 3%. Mortgages are now 3.5 to 4. Again, not great for the consumer, but for the credit union, loan demand will pick up. The loan rates will slowly incrementally increase, as will cash. So to Tim's point, spot on. I mean, you got to model this stuff. Use your AL model for strategic purposes, because this is the year you may have kind of put it aside the last couple of years when rates are zero, nothing's changed, it's kind of boring. If any year you're going to use your model and test a variety of scenarios, look at your liquidity, this is the year. Put things in there that what if the Fed does move 50 in March? What if they move 7 times this year? You could put all kinds of crazy things in there, and it's actually not that crazy because we just don't know. But it's going to change and shift in 2022. Model it. But for the credit union, if things work out as we think, outside of the Ukraine-Russia issue, if the Fed moves methodically, the economy, inflation kind of slow down a little bit, supply chain kind of improves, we can get through this without a recession and come out of this pandemic with GDP growth at 2 or 3%, and things are good for the consumer. It's going to be a great spot for the credit union. It's going to go really well for them. So just patience, model it, test it, understand it, read it, and look at car prices. Keep an eye on inflation. Keep an eye on unemployment rate, because the Fed's focused on unemployment and inflation. Those are the two things, and just keep an eye on that. If you see inflation coming off a little bit, the Fed may be slowing down, but if inflation keeps staying elevated and the Fed keeps raising rates, you, the credit, you're going to know, hey, rates could go higher. The consumer may be spending more of my liquidity, and you got to be prepared for all that stuff.
All right. Well, thank you both. Thank you, Fred. Thank you, Tim. Really appreciate you taking the time. And hopefully you'll come back and have this conversation again in a few months and see where we're at. So, and
we're not going to refer back to anything we said today.
We'll tell you exactly the opposite the next time.
We'll have a new story next time that's going to be spot on. We're not referring back. This podcast gets deleted after 60 days.
Funny. And I also want to thank Vizo Financial's financial strategy workshops for sponsoring today's episode. Get prepared for whatever lies ahead by attending Vizo Financial's 2022 financial strategies workshops. During these one-day workshops, we will hear from financial experts on the market update, the economy, financial strategies, and more. And as an added benefit, you have the opportunity to earn those CPE credits. For your convenience, we'll have 4 locations and dates available for you to choose from. Join us at the date and location that works best for you. You can learn more about the workshop and register at our website, www.vfccu.org. All right. Thank you guys so much. Have a great day, and thanks for listening.